Thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We like to try to give explanation of what's driving mortgage rates on a daily basis, what's impacting them, and sometimes it might be something from the economic calendar or headline news or a combination or even geopolitical. We also get stuff from headline news that might be impacting, or the market market sentiment may be changing. So sometimes good news becomes bad news, and vice versa. And sometimes, if you're not following it that closely, you may be a little confused as to why markets react negatively to good news. And we try to give those explanations for you, so that way you have a little better understanding what's going on here. A little bit about myself is I am a loan officer. I do work with a national lender. We do loans in all 50 states. So if you're thinking about refinancing, or if you're looking at buying a property, we'd love to be able to talk to you and see how we can help you folks out. Uh, so without further ado, please go ahead and we'll start off with the economic calendar. Uh, we'll start off with the Challenger layoffs. These are announced layoffs, as you can see here. It dropped by 5 million from 19.064 to 15.245. So that's good news. So less layoff announcements. That means the job market's getting much better, and it's been pretty strong. Now we get this. This is the second data piece that we get this week. That's important. We had the ADP yesterday. We had the initial jobless claims today, and then tomorrow will be the Bureau of Labor Statistics, or BLS, for the non-farm payrolls and unemployment rate. So that will be the big report with the most weight or impact in the market. Will be tomorrow. So last week's came in at 232,000, but it was revised slightly higher to 233,000. Forecast was calling for 225,000, and it dropped all the way down to 215,000 this week. So that was good news. But if you look at continued claims here, we had last week at 1.476 million. However, that got revised slightly lower to 1.474. Forecast was about somewhere in the middle there, and it came in at 1.476. So obviously unchanged from the initial one, but obviously higher than the revised rate here. So pretty close to the same, but we're still seeing roughly about the same numbers here that we've been seeing. So not much has changed in the continued claims. Now we also got the final revisions to the labor cost for the Q4 as we're in March. So the previous initial one came in at 0.3%. Forecast is calling for 0.3%, and it was revised higher to 0.9%. So we had a pretty big spike, revision to it. Now we also got productivity went from 6.6%, the initial read. The forecast got for 6.7, and it stayed the same. So productivity remained the same, but unfortunately, labor costs went up, and we want to keep an eye on the labor costs primarily because that is inflationary data. So if we see costs for labor going up, that means obviously inflation. That's going to get involved with products and services costs involved with those as well, as they have to keep raise their prices to be able to make the higher payments to the employees and stuff. So again, this is something we'll have to keep an eye on. As we know, inflation is a very big problem right now, and we're trying to get that under control. Now, to continue here, we also got factory orders for the month of January. So in December, we saw a drop of 0.4%. However, that got revised higher, which is obviously a pretty big, again, kind of like it reminds me of the ADP yesterday. Went from negative 0.4 to a positive 0.7. Now, forecast was coming in at 0.7, and it came in much higher at 1.4%. So factors in December really weren't as bad as we were told before, but last month, but it came in much better. And then we also got the 1.4%. And then we got ISM non-manufacturing PMI right here for the month of February. This is the basic services sector. So anything above 50 is considered expansion or growth. We had a 59.9 back in January. Forecast come for 61. Instead of going upwards, it went downwards. So it dropped down to 56.5 here. Now we also have Powell today. He's doing the second day of speaking before the Senate. Yesterday he was speaking before the House. One of the things we did learn about yesterday was that he basically came out and stated that he was going to go with the quarter point instead of the 0.5% rate hike. Now he wants to do kind of a slow and steady, especially with the war here. Because of the war here, they want to do kind of give them the flexibility to go slow and steady. So we'll probably see quarter increment hikes. Maybe there's been forecasts of potentially Now, this one maybe the next 3 months until June, and then it might take a breather to kind of see where things are at. So stay tuned. We'll have to wait and see. That the Fed meeting will be on the 16th of March here, and we'll get more information then. But this is giving us a little bit more insight. So some of the uncertainty is now becoming a little bit more certain, and that's making investors much happier. Now, the reason being, I'm saying that happier is stocks were in negative territory earlier on. As he spoke and kind of learned that uncertainty kind of went to positive. So stocks were kind of buying into the dip. So we were kind of negative territory with stocks, and then they started going upwards into positive territory. Mortgage-backed securities, opposite effect. We're in positive territory, and over the last few moments, we've been kind of going into negative territory. Just as I've been speaking, it just dipped its toe into positive territory at 0.2%. We did see some price improvements, so some of that might go away as we've kind of declined from those price improvements. Yesterday, we ended up closing down 93 basis points. So as you can see here on the chart, we pretty much lost a lot of that growth we had the last 2 days. So that improvement we were getting Monday and Tuesday, improvement pretty much got lost yesterday in one single day pretty much. And right now we're kind of in that same range. So for the most part, we did have a slight improvement. That may be, again, that may be short-lived. So if you guys are in there, you want to lock in now because we don't know exactly where things are going to go. But in the interim, we could see another reprice for the worst, and people might reprice. So if they do for the worst, price will be more likely what we closed down yesterday. Yeah, as yesterday we had multiple reprices due to the volatility in the markets when it dropped that much. So we had multiple pricing changes. So here's a look at what the volatility today. Sorry about that. So as you can see, it went up, and we saw it went down a bit, and we went back up, and we're down again, and we're kind of just went in that positive 0.2% or 2 basis points. So here's you can see the volatility of what we're seeing today. Some pretty big swings in the markets here. And let's take a look at yields. Yields, as you can see, are now at 1.85. We did spike up much higher, closer to the 25-day moving average, but we've come down a little bit. We're down right now about 1.85. Now, lastly, we'll touch on what's the average mortgage rate for right now, and average mortgage rate for conforming limits. These do have points built into it. We'll start off with the 30-year fixed, which will come up here in just 1 second here. It's at 4.08, and then the 15-year comes in at 3.4%. Now, if you watched this a few days ago, that dropped down to 3.9, and then just like I said yesterday's basically brought us back over 4% again, so back into that same level. All right, folks. Again, if you guys got questions, please feel free to reach out. We'd like to be a resource for you folks, so we do greatly appreciate you folks. If you guys like us, please help us out. Smash that like button and subscribe and share us. We greatly appreciate any exposure you can. You guys have a great rest of your day. Thanks so much for watching. I look forward to seeing you guys in tomorrow's video. Bye-bye.